Hello and welcome to today's Market Matters video update. I'm Harry Watt, joined by James Garish. It is July the 7th, 2023. Obviously, that means FY23 is in the books for about a week or so. So we're going to do a bit of a wrap on that last 12 months and a bit of a look forward into the 12 months ahead. Firstly, setting the scene, FY23 off to a bit of a slow start. Markets are a bit jittery, but performance overall seemed pretty good from an index perspective. James, what's your take on that?
Yeah, it was a really interesting year, and I say that quite often recently because there's so many macroeconomic influences that have been sort of barraging markets over the past 12 months. And you rightly point out, I mean, we started the year a little bit flat, but we cracked in and had a really solid year from an index point of view here in Australia, as well as overseas markets, so other developed markets overseas. So the S&P ASX 200 accumulation index put on 14.78% for the year. That, of course, puts the index plus the dividends and that have been accrued over that time period to give a total return outcome for the market. So heaps of different things that could have derailed markets. So, we dealt with the US banking crisis. Regional banks over there obviously had some issues with the pace and extreme nature of interest rate increases over there, the liquidity issues, and that flowed on from that. We've had China coming out of COVID lockdowns and the aggressive stance they took around COVID. That's impacted their growth. A bunch of things that the market has sort of had to digest, and of course that interest rates being one of those major things that were played out in FY23. So overall, a lot to get your head around throughout the year, but it paid to stay the course. It paid to have an active approach in the market, which is what we did, and it paid to sort of keep amending portfolios to align with the different sectors that came into focus, and obviously stocks that were benefiting from the macroeconomic tailwinds and trying to avoid the ones that were hit by the headwinds driven by the macroeconomic environment. So pretty happy with how FY23 played out, to be honest with you, Harry.
Well, that's from an index perspective. I think you've led into how we did performance-wise. Our flagship growth portfolio, it's all about being nimble and flexible. How did that perform in that environment?
Yeah, so this is a large cap ASX top 200 portfolio, actively managed with a growth bias, but it still has some dividend income that's included in there. So it had a really strong year. So it was up over 24% for the period. This is the portfolios that we publish on the Market Matters website. Of course, there is also portfolios open for investment, and the performances will be very much aligned, but they may not be identical. So in terms of the flagship growth portfolio, it put on 24.34% for the year. That was that was over 9.5% above the index, Harry. And you'll see the performance numbers on your screen in front of you shortly. But in terms of 1 year performance, 9.5% above the benchmark. If I look over a 3-year period, it's done 17.3% for the past 3 years, I should say, which is 6% above the benchmark. And from inception, it's been about 5% above the benchmark from its inception back in 2016. So I was really pleased with how that portfolio progressed through the year. That performance differential versus the market was built on as the year progressed. So you sit back here and you give that portfolio a big tick, particularly around the volatility it had throughout the year. So return is not always based. You have to anchor returns to the risk taken to get them. So as I said before, it's a large cap portfolio filled with companies we all know and understand, and getting that sort of performance out of a portfolio like that is really pleasing. So a good one for the flagship growth portfolio.
Yeah, risk-adjusted returns really important for income investors in particular. So our income portfolio, how did that perform through FY23?
I think looking at the performance metrics that when we're putting writing performance reports and the like for these portfolios, the thing that stood out for me on the income portfolio was maximum drawdown through the period. So we've obviously been through a pretty choppy 12 months and ultimately positive 12 months. But this portfolio had a maximum drawdown of 4.8%. So that speaks to me around the defensive qualities in the portfolio. It holds high-yielding Aussie equities. as well as other fixed income securities, major bank hybrids, and bonds and the like. So that portfolio, from a risk point of view, volatility point of view, really performed. But it didn't give out, like it didn't, the ultimate, the absolute performance of the portfolio was also solid. So in 1 year they did 12.23% for the year. So 12.23%. It's got a RBA cash plus 4% benchmark. So it was about 5.6% ahead of its benchmark. And if I look at it on a 3-year view, it's done 13.19%, which is about 8% above its benchmark. And it's done about 3% above its benchmark per annum since inception, which was back in 2017. So volatility low, returns strong, dividends strong. And when I look at the composition of the returns of that portfolio, dividend income was over about 7% of the return. So really, really happy with that outcome, Harry.
It's pretty impressive to have a portfolio that captures about 80% of the market's return for the year, but only having about 50% allocated to the market as well. So
exactly right. It's I can't stress it enough from an investment standpoint. When you think about returns, you've got to anchor it to risk. Always anchor it to risk and the certainty the certainty of return. So that's we're going to move on to a portfolio that's less certain, higher volatility. The returns are more up and down as a consequence of that.
Yeah, definitely. So dialing up the risk, like you mentioned, our emerging companies portfolio, the focus is on stocks outside the ASX 200, so the smaller mid-cap names of our Aussie market. How did that perform as a bit of a tougher year for small cap equities there, James?
Yeah, emerging companies wasn't a great year, but it did beat its benchmark. So the emerging companies portfolio put on 8.84%. Its benchmark was 8.45%, which was the Small Ords. So yeah, we'll take it. We'll call it outperformance ever so slightly. Looking more broadly, from inception, it's about 2.5% above its benchmark since inception. But again, I mean, the Small Ords had a year that was, really, really challenging. Again, it was up, the Small Ords index up about 8%. You look at the large cap index up about, 14.78% inclusive of dividends. That's a really huge, stark difference around the smalls and the larges. So we think that, the lending environment, the liquidity environment, the access to finance, etc., in the smaller space has been challenging as interest rates have risen. There will be a time when that changes, but we're not there. We're not there yet. So we've got to stick to our knitting with that portfolio and continue to work on it throughout FY24.
Yeah, I definitely think that small caps will have their time in the sun again. It's not a position that you need to really throw the baby out with the bathwater. It's a position that will come back and an area of the market that will come back and roar at some point in time, and you just got to hold on until you're there, I think.
I think that's exactly what we're saying on the desk this week. So no one wants to know small caps anymore, but there will be a time where, because of that significant underperformance, they will roar back. They will roar back hard when they do. When we get this risk-on sentiment coming back into the market, that's probably the time to really look at that portfolio and pick some of the eyes out of that, the positions in that portfolio, because I've got no doubt that portfolio will go in for a period of a strong outperformance at some point.
And just beating the benchmark while we're there anyways. The last portfolio that we're going to talk about today is our international equities portfolio. Big access into the US market within this portfolio, James. And having a bit of currency exposure as well plays into performance. How did that one weigh up in FY23?
Well, happy to say this was our best portfolio for the year. So the international equities portfolio put on 25.57% for the year. That was above its benchmark of 21.53%. Looking inception to date, and it'll be on the screen in front of you, is 16.49%, again, more than 5% above its benchmark. So this is a large cap international equities portfolio. It's got a big skew into the US. It's held some of the tech stocks, the mega tech companies that have done particularly well, Microsoft, Apple, and the like. But it's got some really, it's got some interesting other companies in there as well. So it's not just been driven by what this mega tech rally has done. It's about 20 positions in the portfolio. You made mention of currency. The currency put on about 1.5 or helped the portfolio by about 1.5%. Through the period, not significant, but it was there nonetheless. So the international equities portfolio, it's a one that we've been proud how it's evolved over the last couple of years. This isn't available for investment, direct investment like the other portfolios through Market Matters Invest. We are working hard to get that open for investment, so stay tuned for that throughout FY24. But again, another portfolio that outperformed. I like talking about outperformance. I love talking about solid performance. But one thing we will also do is talk about performance when it hasn't been as good as it could be. So that's, I guess, one of the things you get with Market Matters, with our daily reports and also monthly portfolio videos that we're doing today, Harry.
Yeah, definitely. So great suite of performance across the big four portfolios that we publish on our Market Matters website. In terms of looking ahead now, James, market's off to a bit of a jittery start in FY24. Now only a week in the books, though, to be fair. What are we seeing playing out this year, and is it going to be another good year for active management?
I hope so. I mean, you think about the backdrop that lends itself to active management. So it's, when economic conditions toughen, when liquidity reduces from the market, that concept of all boats rising doesn't play out. So you get this divergence between company performance, and therefore you get divergence across stock and sector performance. And that's what really, I guess, feeds into our ability to outperform the market. So if I look ahead, I think those conditions that we've had in the last 12 months continue into FY24. So from a style point of view, I think the active management is going to remain central to our approach in FY24. What happens with interest rates and liquidity and central banks, etc., is going to be really interesting. I mean, only last night we had a lot better economic data coming out of the US around employment. The US economy is holding up better than many feared. So that's a double-edged sword. It means interest rates probably aren't going to get cut. Probably means interest rates may go higher than expected. But if we get this, we're starting to see a tapering off in inflation, which is really key. So it's going to be a year where we need to stay nimble. We'll be writing about our views as we always do each day, and managing our portfolio, as we see fit on a daily basis. I think the set and forget, the passive index style investment, I don't think is going to perform well in FY24. And we think the active approach is the way to go, Harry, and we've seen the performance that it can generate in FY23.
Well, if you'd like to hear more, there's plenty of detail on the Market Matters website. Check out MM Invest. But that's all we've got time for. Thanks for joining us, James, and I hope you all got something out of that video.